Afternoon, everybody, and welcome to our Q3 2021 session on credit trends and economic insights. My name is Becky Oakes. I'm the AVP of Advanced Analytics here at Equifax, and I'm delighted to say I'm joined today by two people. We have Swanima Pandey, who is our Analytics Insight Manager, and we also have Kathy Katsouleras, who is our AVP of Consulting. Before we get started into the actual detail and the information, Jordan is just going to talk you through a little bit of housekeeping. So Jordan?
Good afternoon, everybody. Thank you, Becky. So each area within the platform is responsive so that you can maximize or minimize each widget or box based on your viewing needs. Our presenters are on camera in the media player on the left side of your screen, and there is an Ask Question widget just under that. So feel free to enter any questions you may have, and we'll address them throughout the session today. In the event that there are too many questions to get through, we will generate an FAQ document, which we'll send out to you in the coming weeks. Today's presentation is available in the related content widget for downloading on the left, and bios of our speakers appear on the right. Slides will show in the middle of your screen, and the French presentation will be available in the next few days. Today's webinar is being recorded, and you will receive the on-demand link via email tomorrow. We have a short survey which we'd ask you to fill out, which will be automatically pop up at the end of the webinar, and you can access it by clicking on the survey icon at the bottom of your screen as well. To the right of that survey icon is a Contact Us button. Please send us an email if you'd like further information, and a team member will be happy to help. With that said, let's get started. Becky, back to you.
Thank you so much, Jordan. So, as always, we really want to start with what's going on the economic side of things here in Canada. And it's probably no surprise that one of the big talking points we have currently is really around the rise in inflation that we have seen over the last few months, and potentially what that could mean in terms of down the line for the Canadian credit market and some of the kind of consumer behaviours that might occur as a result of that. So that left-hand chart, we have inflation rates. So the blue line is everything, and the orange line is excluding energy. And as we saw kind of in the kind of end of Q2 and into Q3, inflation has really picked up again during 2021. So even though we kind of did have a little bit in 2020 where that was kind of flat or actually dipped a little bit, you know, day-to-day prices of things have been on the rise. And that is one area that we are closely monitoring because it can have a significant impact on how consumers use credit. And one of the reasons for that is really around as day-to-day items, so things that people are going out and buying, you know, be it food, be it kind of clothing, you know, fuel, energy, anything like that, you know, as those things start to cost more, that can lead to consumers starting to rely more on credit in the short term to help them through some of that period. Because if income isn't increasing at the same rate, then obviously there's a bit of an imbalance there. So the right-hand chart, you'll see what's actually happening at kind of some of the breakdown at an industry level. So that big bar, which you see kind of fifth down, that is gasoline. So we all know fuel prices are really kind of been on the rise last year and into this year. So that still continues to be one of the drivers of inflation. But you'll see right at the bottom there, food is up, and it's up compared to last year, and it's up compared to 2019, and we all need to eat. So again, that's kind of one of the things where, you know, consumers will be kind of feeling a little bit of additional kind of pressure or kind of less money in their pockets as they're going out and kind of making those purchases. Now, the good news in some respects is that economically, when we look at what's happened with some of the benefits and the support mechanisms since COVID started, that has really helped consumers out. So that left-hand chart, that was actually the benefits that were coming from the government during COVID through to kind of Q3 of this year. That's the grey line on the left-hand chart, and the blue line is employment income. So even though we did see a bit of a dip in employment income, particularly during 2020 when we had those initial waves of lockdown as a result of the pandemic, the government support has been really, really high, and it still is high right now. Now, that's the good news. Of course, the concern right now is that some of those government support mechanisms have started to pull back a little bit in October this year. So, you know, many consumers perhaps aren't going to have that benefit going forward. And that's really something we're going to be focusing on as we kind of look at the Q4 numbers in kind of February. The right-hand side, this is looking at disposable income and household saving rates. So again, the other good thing in relation to things costing more due to inflation right now is that actually saving rates were the highest we've seen for a very, very long time during the pandemic, and that has continued. Now, in Q3, we saw that dip a little bit, and that's likely due to two factors. First of all, you have spend has been on the rise, so a lot of consumers are going back out again. They're kind of doing things like booking vacations, or at least they were before the latest variant kind of reared its head. And so they have been spending a bit more. So that potentially has meant that that savings rate has dipped a little bit. Obviously, the other piece is inflation again, because if things are costing more, even though disposable income is still relatively high, which is the orange line, it's still going to impact the ability to save if things are costing more. So it's kind of a bit of a interesting period when we look at inflation interest rates, because we know the Bank of Canada was talking about potentially raising interest rates a little bit earlier next year than they had originally planned, but that was before the latest variant appeared. And having that variant could lead to additional lockdowns coming up. It's still very uncertain. So as and when that interest rate rise will happen, still is a little bit unknown, but it is still one which we are cautioning in terms of over the coming months, because that interest rate rise could start to have a impact on consumers and their ability to keep making those repayments on the credit side. So that's kind of the economic side of things. If we start stepping into what's happening at a very high level in terms of credit trends, probably no surprise really, when we look at what's happening with average consumer debt, it is still down compared to this period last year, and definitely down compared to pre-pandemic. And if you've joined some of our previous webinars, you'll know that that's really been driven by a kind of a combination of both reduced spend and increased payments when it comes to credit, and that's helped to reduce some of those balances. What we have seen in Q3 is that started to increase back up again, and we'll be talking in more detail where that's coming from, but credit card spend is one area in particular where we're starting to see people going back out and kind of putting some spend on their cards, and that spend rate is actually a little bit higher than payments, and that's kind of one of the reasons we're seeing the average consumer debt start to pick back up again this quarter. When we look at financial stress, though, insolvencies and delinquencies, they are still in a pretty good position. So insolvencies is down compared to Q2. It is up compared to last year, but again, last year was one of the lowest points we've seen on the insolvency side. And again, that's because those lockdowns meant that there wasn't much court activity happening, plus those government support and lender support mechanisms that meant that people weren't being pushed into insolvency necessarily during 2020. But delinquency, which is on that third kind of area, that is still really, really far down. So again, year on year, down 22%. Even compared to Q2, it's dropped again, down another 9%. Now, of course, the big area where we've seen a lot of rise still remains mortgages. Now, we know that Q1 and Q2 were really high in terms of mortgage activity, and that's both kind of new homeowners as well as kind of renewals, refinancing, and people just moving house. That has continued to be up in Q3, although it has slowed a little bit. It did slow down a little bit during that Q3 period. So when we look at kind of the key themes for Q3, as I already kind of mentioned, credit card spend, that started to increase ahead of the holiday season. And when we kind of look at that at a average credit card spend per holder of a credit card, that's up 4% compared to pre-pandemic. So even compared to before all the lockdowns and things happened, we are seeing the average spend start to increase a little bit this quarter. The good news, of course, is that, again, that hasn't translated into massive rises in balances. It is increasing because payments are lower than spend, but it's not by any means jumping up yet. So that is still relatively stable. As I just mentioned, on the mortgage side, we've seen that growth slow down a little bit, and we've kind of seen volume drop off. What we are still seeing, though, is that house prices, particularly in some of those really hot markets, that remains very high. So we're seeing average mortgage amount has increased again this quarter to around $360,000. So quite a hefty amount when you're looking at the average mortgage. And then again, finally, just again on that delinquency side, those government incentives, still having a good savings rate, a good high disposable income, that's really helping to maintain, or at least it did in Q3, that low level of delinquencies and missed payments on the credit side of things. Again, one to watch is going to be the impact of that pullback on the government support that started in October, and what happens next year if interest rates and things start to rise, combined with kind of the inflation side and some of those kind of higher prices. If we break this down at a product level, That left-hand chart, this is the overall debt, which reported to us now stands at 2.2 trillion. And you can see the grey, which is the non-mortgage side, and the blue, which is the mortgage side. That huge impact of the mortgage piece, which is up around 11% compared to the same period last year. Like I say, non-mortgage debt is down compared to last year, still a little bit. But again, it's increasing compared to last quarter. And so the last 2 quarters, we've seen that start to rise. So that is kind of a trend we're starting to see as consumers are starting to put more balance back on the use of credit. At a product level, it's probably no surprise. We're still seeing, most of those products are still down compared to pre-pandemic and compared to last year. Installments are still up a little bit. And that's the only place where we've seen just a little bit of increase come through. So I'm going to hand over to Swanima, who's going to talk to you a little bit around what's happening on new growth on the credit side of things. Swanima.
Thanks, Becky. So let's look at new credit growth this quarter. We'll start with credit cards. So we have discussed in length in our past webinars that credit cards have seen the slowest recovery during the pandemic. New card volume has not yet reached pre-pandemic levels, but it's starting to show an increase, especially among younger consumers under the age of 25. And this is the only segment where we saw new card growth reach 2019 levels this quarter. We are also seeing a high growth in consumers with credit score lower than 700. Now, this can also be related to the fact that a lot of younger new to credit consumers usually start with a lower score. So most of the new growth is coming from under 25 segment. Hence, we are also seeing a rise in consumers under 700 score segment. But till now, we have not seen any increase from high score and older consumer segments. One good news is that credit limit on new credit card is increasing. At the peak of the pandemic, we saw lenders pull back on credit limit on new cards. But now that credit limit is increasing back again. It is up 18% from the lows of Q3 2020. So hopefully we'll see more growth in new card volume in the coming months. Sorry. Now, unlike credit cards, new auto finance and bank loans showed good recovery from the lows of the peak pandemic period. And this quarter, despite a high demand, new auto volume showed a drop when compared to Q3 2020. Now, we all know that supply chain issues have been a big problem with the auto industry, and it is affecting new auto volume. If you look at the chart in the middle, it shows the time difference between booking a vehicle and vehicle delivery. So the wait time for new vehicle has almost doubled since the pandemic, especially for new car. Hence, we might see some more delay in new auto growth. And this lack of vehicle availability and increased demand has also had an effect on vehicle prices. So if you look at the rightmost table, you'll see when compared to the pre-pandemic period, average auto loan amount is up by 8%. And the maximum increase is coming from Ontario, BC, and Quebec, where the demand has been the highest. So a lot of supply chain issues, lack of vehicle availability is having an effect on not just new volume of auto, but also the overall average loan amount for auto. Now, another credit product where we are seeing a slight slowdown in year-over-year growth is mortgages. I mean, it is still showing a 7.7% increase when you compare to Q3 2020, but it's also showing a 15.6% drop when compared to the last quarter. So, which is not very normal because normally we don't see such a big drop from Q2 to Q3. So this volume is still quite high, but looking at the pre-pandemic growth, it is slightly lower than the previous quarters that we have seen. But slower new mortgage growth has not slowed down house prices. So average loan amount is still up by 18.3% when you compare to Q3 2020. So high house prices have led to a shift in high value mortgages. So mortgages with loan amount greater than $850 now form 6% of all new mortgages, unlike 2019 where they formed only 2% of all new mortgages. So mortgage debt per new mortgage holder keeps increasing. But most of this new mortgage growth is coming from consumers with a credit limit of 680 and higher. So it is evident that lenders are being cautious with mortgage adjudication, as there has been a massive drop in consumers with low scores when it comes to new mortgages. So it is hard for low score, riskier segments to get a new mortgage. So far we have seen credit portfolio growth and new account growth. So let's change gears to credit performance. We continue to see record low delinquencies across all products. Delinquencies fell further from last quarter, and it is at the lowest it has ever been. So government support has definitely helped consumer clear up their debt obligations. If you look at the credit card delinquencies, again, it has remained low, but there's a slight increase in revolving behavior. So the chart on the left side shows 90-plus delinquency rates for credit cards, as well as the percentage of revolvers, so consumers not paying their balance in full. So currently, the small increase that we are seeing may be a sign of things to come, because in an unstressed environment, consumers follow a payment hierarchy. As you see on the chart on the right side, so mortgage and telco are usually the last to go delinquent, because mortgage is obviously a big fixed payment. Nobody wants to go delinquent on their mortgages, and telco being a very high utility product that you actually need, so people don't go usually delinquent on these two products at first. So, but credit cards are usually the first product that they will go delinquent on. So increase in revolving behavior may translate to more delinquencies in the coming months, but it can also be temporary because of the high spend activity among credit card holders that we have seen this quarter. In either case, we'll closely monitor any change in credit card delinquencies, as it can help us identify early signs of financial stress. Sorry. So auto delinquencies, as you can see, are also at their lowest. But if you look at the pre-pandemic trend for auto, it was very concerning, as it was rapidly rising from the second half of 2018. So pandemic has reversed the trend for auto delinquencies, especially for consumers under 25 years of age. So even if they form a very small percentage of total auto balance, they had the highest delinquency rate pre-pandemic and have seen the biggest drop in delinquency during the pandemic. So that makes this segment very vulnerable to government support ending. Now, as for mortgage delinquencies as well, all regions continue to show big drop in mortgage delinquencies. When the deferral programs ended, there was a speculation around mortgage deferral cliff, where people were expecting delinquencies to rise back up after the end of deferral programs. But thanks to government support, we have not seen that increase in delinquencies of mortgages. So they have continued to follow a downward trend. Another fact that we should take in consideration when looking at mortgage delinquencies is the growth of new mortgages, especially new balance, because some delinquencies might be masked owing to the huge growth in balance. So the chart on the right shows mortgage balance growth against 90-plus delinquency rate. And you can see how the small rises in delinquencies come from a period of slowdown in mortgage balance. So the denominator effect may hide some financially stressed segments. Therefore, we need to take into account the new balance growth when looking at mortgage delinquencies. Now, just like delinquencies, bankruptcies have also remained low. There was a brief rise at the end of 2020, which was mainly caused by delayed insolvencies due to court closures. But post that, insolvency rate has followed the same trend as delinquency rate. So the year-over-year increase in some regions that you see is mostly artificial, because it is being compared to the lows of Q3 2020. So bankruptcy, as you can see by the chart, it's still very low. So normally insolvencies and delinquencies, they're highly correlated and they follow the same trend. But if you look at the chart on the right, in 2018 and 2019, we see a slight divergence in insolvency and delinquencies, mainly because consumers opted for insolvencies without going delinquent. And we can expect the same behavior to resume as consumers start feeling financially stressed after the government support ends. Now, let's look at a global view of delinquencies. So here's the global view for mortgage delinquencies. We have been closely monitoring a lot of trends from other countries, which may help us anticipate the change that may come to Canada once government support ends here. So US and Canada show similar delinquency trends. Australia and New Zealand were the first countries to lift up restrictions and pull back some government support in the last quarter. And that's where you see a slight increase in mortgage delinquencies. But this quarter, the delinquencies fell again as some of the government support was extended. Both these countries went into new lockdowns. So So delinquencies have been heavily linked to government support across the globe. And we anticipate seeing a rise in delinquencies for next year as government support for most people in Canada has ended in October. So we'll dive more into these things that affect credit payment in the next section, which will be presented by Becky. Becky, are there any questions?
We do have some questions coming through. So I think it's probably a mix for myself and you, Swanima. So there's a question that came through around what is the average credit limit per new card issued now at the end of Q3? So the new credit limits on cards was a little bit below $4,500.
Yeah.
Now, if you go back 12 months ago to Q3 2020, that had fallen dramatically. I think it was around 3,800, Swanima, I think, wasn't it?
Yes.
So, you know, what we did see during 2020 was there was a drop. You know, lenders did pull back a little bit when we had that initial period of, you know, what's going to happen as a result of the pandemic, but that did very quickly recover. So actually, this quarter compared to two years ago, it's very similar in terms of average limit on the credit card side of things. Then we had a question which was, would it be fair to say that rent payment is also one of the last things to go into delinquency? I don't know, Swanima, if you have a view of that.
So we don't have a view of the rent payments because that's not a credit data that we get. But definitely that would also be one of the last things people go delinquent on. And that's why credit cards and other revolving products or unsecured products will see delinquencies first, because they're both very important. Mortgage as well as rental payment, they're both very important aspects of anyone.
Yeah. And then Swanima, just another one. Can you tell if the new mortgage numbers are mostly driven by new consumers, i.e. first-time home buyers, or repeated buyers?
So around close to 30% of new mortgages are usually first-time home buyers, and rest are all renewals and refinance. We did see a small increase in the first-time home buyers initially at the beginning of 2020, but we started to see a small drop. But it's not a big drop, but the composition has changed, like from 29%, it became 28% for this quarter. So we did see a small drop in the composition of first-time home buyers, but a lot of refinance and renewal activity is also fueling new mortgage growth.
And I think actually some of the link to some of that, and I know it's one that we were asked a couple of quarters ago around first-time home buyers and are they being priced out of the marketplace due to these kind of, you know, really high house prices. You know, the important thing is when you look at what's happened, particularly during 2020, in relation to mortgages that are on offer and the interest rates of those, what we saw in 2020 is that the average mortgage amount went up, say, around 10%. But the scheduled payment amount, so kind of what a consumer has to make on a monthly basis, that was fairly static. So initially during 2020, we didn't really see first-time home buyers being priced out of the marketplace, particularly because of those really low interest rates. And those really low interest rates also helped fuel renewals and refinancing. You know, again, just because it's a good time to renew. And also linked to that, if you go back to 2016, kind of 5 years ago in 2017, you know, that was another period of low interest rates and a real boom in the housing market. So there would have been many consumers that fixed their mortgage interest rate term for, say, you know, 4 years, 5 years. At that period, they were coming up to term naturally. And actually, that was an area of concern we had kind of 18, 24 months ago, which was what happens when they come up for renewal if interest rates are higher. Many of those are going to be protected from that because of COVID. The interest rates are now much lower as a result of kind of, you know, the situation we're in on that side of things. Now, during 2021 for first-time home buyers, you know, we have started to see, again, mortgage amounts have increased even further, but scheduled payment amounts are starting to increase a little bit as well, you know, as some of the lenders are starting to preempt, I guess, some of the interest rate changes. Just linked to that as well, there was a question, can we honestly say that in general, Canadian households have better balance sheets and are better off in light of increased mortgage debt and indebtedness and affordability challenges? And that's a great question. And there is a big unknown here because, you know, we have been through this period where a lot of consumers who were previously, you know, financially stressed, actually they've been protected to a huge amount by a lot of these government support mechanisms, They definitely have been paying off more of their debt, which is the good news. In terms of where that's going to go and the impact of what happens down the line, now inflation is picking back up again. Now that government support has pulled back a little bit. That is where we're going to start to see some consumers that maybe have managed up until now potentially tip back again into some kind of degree of financial stress. If you go back to when we were talking in 2020 and we talked about deferral programs as well, 1 in 5 of consumers that took a payment accommodation, a deferral from a credit lender, they were already delinquent. So the good news is some of those did get out of debt, but again, there's still many of them are going to be pretty close to the edge. And, I think it's going to be interesting to see what happens over the coming months. So there was another question, which was, do you expect insolvencies and delinquencies to go up to pre-pandemic levels and higher? Which is a great question. I think if you look at the chart we have on the screen right now, and this is mortgage delinquency, what we did see in New Zealand, expect it to rise over the coming months, but whether it will go immediately back to pre-pandemic levels or whether some of those saving levels that some consumers have managed to accumulate will give a little bit of buffer. What else have we got? We had a question around, I've lost it. We had a question around, can you possibly speak to how the upcoming expected increase in the Bank of Canada interest rates may impact mortgage delinquencies? So I can speak to that, and Swana, feel free to jump in. In the short term, the real impact is going to be on consumers that have variable rate products. And actually, it can take a bit of time. I'll talk through in the next section what we saw historically with interest rates when they rose last time. But in the short term, it will be more on if you have a variable rate mortgage or variable rate products, that's where the initial impact will be. The good news for mortgages, of course, is the stress tests that are in place are designed to kind of deal with some of that, to kind of, have a buffer so that if interest rates do rise, it doesn't tip everybody over on the mortgage side of things. So, consumers that have been getting new mortgages over the last 12 to 18 months, you'll probably find that actually they will weather the storm quite well initially, even if they're on a variable rates mortgage to start with, because they're going to have some buffer that's in place. Now, obviously, inflation can impact that, but that is kind of some of the good news. If you have a slightly older mortgage that's variable rate, the risk is always going to be, have you accumulated more debt since that was originated, and therefore could that tip you over the buffer that the stress test kind of deals with? That's potential. I think the real risk is going to be down the line. There are a lot of people that have taken high value mortgages over the last kind of 12 months. We've seen kind of, the percentage of, mortgages that are originated over 600,000-700,000, that has really increased. And down the line, when you go fast forward in 3 years, 4 years, 5 years time, if they're on fixed rate mortgages now and interest rates go up, then that potentially could be a bit of a challenge later on when they come up to renew at that point in time. So I know we have a few more questions in there, so we'll come back to those in a few minutes. I do want to make sure we've got time to go through the rest of the information, and Kathy is going to be doing a piece for you around the so what. So kind of how can this, what should you really be thinking about during this time? But before we go on to that, here at Equifax, it is really important to us that the information that we're bringing to you and the insights we're sharing is, we want to ensure this is valuable for you. So we'd love to do a quick polling question with you, which is, is there any interest in us deep diving a little bit more into a few different topics? So there is a polling question on the screen right now. So please have a read of those and see if any of these would be of interest, just so we can kind of tailor some of the information we share with you. So, are you interested in more detail around what's happening at the global versus domestic side of credit trends? So Swanam just shared something on mortgages, but is there a bigger desire for kind of more deep dive into that? Is there a focus on new to credit and new to Canada and what's going on some of those trends? BC's obviously had a really difficult time with the environmental challenges. Do you want to dig a bit into the economic impacts of those? What about kind of the mortgage industry and looking at kind of multiple mortgage holders? There's been a lot of press recently around investors Is there any interest for us to deep dive more into that? And finally, is there any information or additional insights you'd like around different consumer demographics, so age segments and how they're adapting to different market conditions? So please, if any of those are of interest, do click one of those. I'll just give you a few seconds. Okay, so let's have a look. So new to credit, new to Canada is definitely of interest. A bit more on the multiple mortgage holders. Okay, that's interesting. I know we've had a lot of journalists asking us about that recently as well. So what we will definitely try and do is either in our upcoming Q4 credit trends that'll be in early in the new year, we'll either cover some in there, or we may look at doing a particular webinar focused on those two things. So thank you for doing the poll on that one. Okay, so I'm going to just very, very quickly talk on what could the future hold in a bit more detail and what we saw historically when it came to interest rate rises in Canada and kind of what that could mean if history repeats itself. Now, I will caveat this heavily with the past does not always predict the future, because this is a very different period that we are in right now in terms of, consumers having reduced their debt to such a degree, the government support. We haven't seen a period quite like this before. But it's always good to see what happened in the past, because there definitely will be some elements that could occur in the future. So if we go back all the way to kind of 2008 and the huge recession that we all saw with the banking crisis right through to here, there's kind of 3 or 4 key areas that we have been focusing and paying attention to. So the recession itself, kind of the impact we saw in terms of delinquencies and the stress that came through. We have in the green on that left-hand chart, the Alberta oil crisis, which certainly can have an impact on particular regions. Out in Alberta, when there is a lot of volatility in oil prices, that can lead to kind of increases or decreases in delinquency. We've seen that several times before. And then in blue, this is where we had that big increase in interest rates for kind of several quarters in a row, following a very low period. And you'll kind of see as we talk through kind of the impact of some of that, but it definitely had an impact on delinquencies, and as Swanova mentioned earlier, the insolvency piece. And then finally, in that orange bar, you see the huge impact of the pandemic and what an unusual recession that's actually been, because delinquencies have been so unusual in terms of the way they've dropped off. And now when we look at what could happen in the future to delinquencies, as I mentioned earlier, there's kind of 3 things that we're really thinking about. There's, what's that government support going to do? It did start to pull back in October. Will that need to be reinstated depending on what happens with this new variant? Potentially. So that's always going to be one to watch. The credit sensitivity to interest rates. So some consumers, if the interest rates go up, they may not be impacted at all. But for others, it could have an immediate impact on the amount of monthly payments they have to make, and that can cause some stress. And then, of course, that inflation piece as well. If things go up, that can mean that consumers need to use additional credit to support them through that period. And that eventually can lead to financial stress if the economy doesn't recover to the same degree, or inflation rates don't get under control. So when we look back a little bit at that interest rate period in 2017 to 2019, this left-hand chart, this is actually HELOC delinquency. And the reason we focused on HELOCs is HELOCs tend to be a variable rate product for a lot of consumers. So as interest rates go up, instantly those payments, the minimum payment amounts rise as well. And also HELOCs tend to be high balance. We see kind of tens of thousands average balance on HELOCs. So that's kind of one of the reasons why we focus on that. So the grey line you'll see there is the interest rates, and you see they started to rise in 2017, peaking kind of middle of 2018 into 2019. And then that huge drop, of course, when the pandemic hit at the start of 2020. The red line showing that delinquency, you'll see that it was pretty stable for HELOCs, but once those interest rates started to rise, we saw a big increase in delinquency on that variable rate product. When we break that down into where we saw that across the population, which is the right-hand chart, actually where we saw some of that increase in particular was around some of the older population. So this is actually bankruptcies on this right-hand side. So we saw the 65-plus group being stressed in particular because they maybe didn't have any buffer at all, and maybe had HELOCs and things and variable rate products that pushed them over the edge. And then we kind of saw, additional increases across some of the 36 plus as well. The under 36 didn't have as much reaction to it, and that's probably because they haven't built up as much balance on those HELOCs and variable rate products and things like that. They tend to carry a little bit less average consumer debt, and that's kind of one of the reasons why. What's interesting when we look at the pandemic, though, is although across the board, when we look at insolvencies, many of the age groups have seen that big drop. The older consumers, the 65 plus, they've kind of stayed pretty stable. Now, one of the hypotheses behind that is probably they haven't benefited as much from things like government support because perhaps they aren't, there's less of that group that are working. There could be many things that are impacted, yet they've still got inflation and things coming through. So, if perhaps they are pensioners or they're kind of, not in employment right now, goods are costing more because of inflation. And actually there isn't many benefits to kind of support them through to the same degree that we've seen for other kind of age groups. So that's probably one of the reasons why that period has stayed high for that age group. A lot of numbers on this slide, but what we've tried to do is if we go back again to that 2017 to 2019 period where we saw interest rates going up and we saw movement on delinquencies, we've tried to just break that down into, okay, what did we see across different indicators of financial stress linked to kind of rises in interest rates? So you see there's kind of 3 different columns on there. We have after the first year where it was up 50 bips in terms of interest rate, the second year up 100 bips, and finally by Q3 19 where it was up 125 bips. So there's a few numbers on there. You see the transactor rate, which is the percentage of credit card holders that are paying in full. That did drop a little bit. On the insolvency side, we saw, even after kind of the first year, we saw a jump in insolvencies. And as Swanema mentioned earlier, we tended to see more surprise insolvencies. So where there wasn't prior delinquency in that first initial period, it was enough to just push them straight over into insolvency. And likely kind of a lot of those, I think, went with consumer proposals because they're protecting some of the assets. That was particularly high on that 65 plus group. By the time we get to kind of towards the end of 2019, insolvency was kind of up 23% compared to 2016 and 36%. So big jumps in insolvency following that interest rate rise, but it started to come through kind of 12, 18 months after the interest rates were increasing, and it was after several steps of interest rate rising. So potentially as interest rates go up, we might not see anything initially, but if we continue to get up to say, a 125 bip rise, that's where we could start seeing some real stress start to come through. And then you can also see below there, we have non-mortgage delinquency 90 plus rates. Again, similar thing, once we reach that 125 bip increase and there'd been a sustained period of higher interest rates, that's where we started to see, in general, the population going delinquent a little bit more. There's 10% up. And when you break it down again into the older population or consumers with variable rate products like HELOCs, almost 20% increase in delinquency levels for those ones. The good news is that mortgage didn't really get impacted as much. And again, that's probably because, first of all, it's top of the payment hierarchy. And also, there's a lot of consumers that don't leverage HELOCs, so don't have large variable rate balances, and mortgages tend to be a bit more fixed rate. So that's maybe potentially something we should be watching for, as interest rates maybe rise later next year. That's the kind of thing you might expect over the following 12 to 18 months. But again, it's a very different period right now. So, things may be a little bit different. So I'm going to pause there because I've been talking far too much. Swanema, was there any additional questions that have come through?
I actually answered a couple of additional questions. Maybe we can take up more questions after Kathy's session. Okay,
sure. So I would like to hand over to Kathy Catzelares. As I mentioned earlier, she's our AVP of Analytical Consulting. So Kathy is really going to help break all this information and trends down into potentially what you should be thinking about right now. So Kathy, over to you.
Thanks, Becky. So I'd like to focus in on some key takeaways from what we've heard today and actually bring it all together and talk about what they actually mean. So as we saw, inflation has been increasing year over year and now at a much faster rate. So this is definitely going to impact consumers because day-to-day goods and services are now going to cost more. So if costs are going up, but salaries and income are staying constant, this might create an issue for some consumers' affordability. And it may lead to some consumers requiring to leverage their credit or their savings just to get by. So this relates back to what we saw in terms of the trends being that the non-mortgage debt levels are slowly rising. So for the consumers as well that were dependent on those government support programs, well, those just ended in October. And in some cases, some of these consumers were actually receiving more money than they would now, perhaps having re-entered the job market. So the concern here is really that, having a reliance on certain income levels, plus now factor in inflation, it might mean that some of these consumers might be in a position of financial stress. Now, we know how we know how monetary policy works. So the expectation is the government's going to look to increase interest rates to curb inflation. So the intent here is really for consumers to slow down their spending and really shift their focus in on saving given the higher rates of return that they can yield. So bringing all of this together, what does this mean to a lender? Well, it's going to be important to really monitor and identify pockets within your portfolio of consumers who will be significantly impacted by inflation. So there might be early signs of an increase for credit demand or using existing credit products, which can be indicated with higher utilization rates. Payment rates might start to decrease. And of course, looking for rising delinquency and insolvency rates. So the next area I want to talk about is supply chain issues. So we've all heard about the concerns related to these shortages, but more specifically for the auto market, it's the shortages around the semiconductors that is impacting the ability to produce new vehicles. The expectation here is that it's going to last well into the new year, probably somewhere around Q3, perhaps it might correct itself. So given that there's fewer cars for consumers to buy, we've seen consumers also shift to looking at sort of the used car market. So this surge in demand, again, and the low supply has resulted in really prices shooting up on both sides of the fence for both the new cars and the used cars, as well as the delay related to that increase in wait time to actually get the vehicle delivered. So what does this all mean to a lender from a risk perspective? Well, a couple of things. First off, we just mentioned high demand, low supply, prices are going up. So when these loans get booked, it's going to equate to a higher LTV value. And at some point, the supply chain situation is going to correct itself. So you're going to have a pool of consumers in your book that are going to have loans that are higher in value than what the asset is worth. So as a lender, it's going to be important to be mindful of these higher LTV values as part of your adjudication process. So for new vehicles, we talked about this delay, the delay in getting those new vehicles delivered. So essentially, this is the time between the buying stage and the funding stage. Again, as this increases, what lenders need to be mindful of here and really sort of look out for is to ensure that that consumer's credit position or their situation has not significantly changed during that time. Last thing is, again, because there's going to be less vehicles available for sale, this could mean fewer deals and more competition. So as a lender, it's important to ensure that your rates and your pricing are competitive to win. So moving away from the car market, from the auto market, let's shift gears and talk about the housing market. So we've seen that during COVID, there's been an increase in demand as well as home prices really just shooting upwards. We've also seen a flurry of renewal and refinancing activity because of these low interest rates. And we've also seen consumers really sort of choosing variable interest rates over the fixed rates. And so with prices going up, but interest rates being low, many consumers have taken on these larger mortgage amounts and have actually been comfortable signing up to these higher debt levels. We even saw that first-time home buyers have been able to enter the market with under these conditions. And Becky and Swarnema both mentioned this earlier. We've also seen that the monthly payment amounts have actually been pretty steady or have increased at a slower rate. So what does this all mean? Well, we mentioned earlier the concerns around inflation, and there might be some financial stress for some of the consumers. And so for lenders, again, Becky mentioned this, but I'll just elaborate a little bit. We talked about sort of, the stress testing that's done as part of the underwriting process. It'll lower the risk in the short term because that consumer has already been tested to ensure that they can withstand any of the market changes. So that stress test really ensures that there's some sort of a buffer. But when total debt levels start to increase because of inflation and the cost of goods increasing, it eats away at this buffer and can lead to some financial stress for that consumer. You might be able to see, again, some early signs of this as part of that payment hierarchy that's where Nima showed us. And this is where it's important to identify that population and really monitor them. Next year, we know that interest rates are going to rise. So it's really important as a lender to look at the population that you have that have existing mortgages who are coming up to the renewal point or need to renew because their term has ended, and really understand what rates did they originate on and whether or not they even were originated outside of the stress testing requirement, which I believe came into effect in 2018. We know that the payment amounts are going to actually change and go up. So it's really important as a lender to understand your consumer's ability and capacity to take on these increased monthly payments and what their overall financial position is. Last thing I just want to touch on is with regards to, again, the interest rates increasing, monthly payments also increasing, that first-time home buyer might actually end up being priced out of the market. So the last area I want to focus in on is really sort of the card market. Again, we've seen demand slowly start to pick up, given that during the pandemic or the height of the pandemic, it was the worst hit in terms of new growth. We saw that really during this time, consumers were just really focused in on paying down their balances and really spending less. So fast forward to now, we see that spending has started to increase, and this can be really correlated back to, consumers feeling more confident, of course, sort of lockdowns being lifted, vaccination rates are increasing, people are more comfortable going out, spending, and really even making plans for like big ticket items like trips. Everybody's just looking to get back to normal. And so as a result, we see that the spend to payment ratios are actually now increasing. If we double click on this, and Swarnima talked a little bit about this, we really see that the younger population is really playing a dominant role here in terms of new card growth and spending, as well as leveraging buy now, pay later, which is growing in popularity and may be seen as a possible threat / disruptor to the card market. So what does this all mean to the lender? Well, actually, what does this all mean? First, I'll start with what it means to perhaps card groups. So with the increase in activity and competition, card groups should really be looking to assess how are they being competitive and what makes their product more attractive to those seeking new credit, especially when there's other options like buy now, pay later in the market. For lenders, for card lenders, again, tying this back to what we talked about with regards to inflation, prices are going up, you got consumers that were dependent on government support, that ending. Again, some of these consumers or these pockets of consumers might need to turn to leverage their credit cards to just manage their expenses. So the risk here is, again, referring back to that payment, that triangle, the payment hierarchy, cards are sort of at the bottom. And so if you're going to see delinquency, it'll probably appear with your cards. So some of the early signs to look out for as a lender in terms of what you should be looking for is, again, identifying the pockets where you've got payment rates starting to decrease, where you see transactors becoming revolvers, and essentially just seeing that there's a trend that's growing over time. And really, again, just understanding your consumer's overall financial position. So I'm going to end here, and I hope sort of connecting the dots in terms of what you've heard today, as well as what you can do, have really been insightful to you. So Becky, I'm going to turn it back to you to see if we've got any questions from our audience.
Thank you so much, Kathy. So yeah, we did have one, which is what is driving up credit card utilization in Q3, and kind of what are some of the drivers behind that? So Swanima, do you want to take that one?
Yeah, sure. So we are seeing higher spend, but we are also seeing higher payments. So that's why we are not seeing the same growth in balance. So the overall credit card utilization has not increased. It is still low, especially when you compare it to pre-pandemic levels. But it's just that as people are spending, they are also paying off their balance. So balance growth has not increased. Therefore, you don't see that increase in utilization.
Fantastic, thank you. There was a question regarding auto loans. What are the trends you have observed for average auto loan sizes? So I know they're definitely up, would be the short answer to that. If we look at new auto loans, so kind of what is actually reported to us as an auto, I think it's up around 3% compared to this time last year and 8% compared to 2019. Does that sound about right, Swanima, for new auto loans?
Yes.
It's up quite a lot. And we are seeing, in the bank installment loans, that's kind of increased as well on that side of things. There was a question just around interest rates. Do we think it actually will rise in 2022, given some of the, the really unusual period we're in? And actually, is it more the heating, energy trends and things? I think it's a great question. And, thankfully, I'm not a lead economist for the Bank of Canada, having to worry about some of this stuff. I think the thing to bear in mind is that inflation is linked to both supply and demand. And I know we hear a lot about in the news right now around some of the supply chain issues, things like gas prices as well. But actually demand is probably picking back up again as well. That's our view, which is, and you see that in the credit card spend kind of really, increasing. We're seeing some significant jumps in some groups on spend on the credit card. And again, payments are still there, but spend's up and people are booking vacations and highly expensive flights like I've done recently. So, I think that is kind of a potential that means, inflation, it might be temporary, but it might also be here for an extended period. Because some of the supply chains, like on the auto side, I don't think that's going to go away anytime soon. That's going to be well into 2022 before auto gets back to normal. And some of the, if you've got increased demand, that puts additional pressure on the supply chain. So if that does continue, eventually, we need to do something to curb that inflation piece, because otherwise consumers simply will not be able to afford day-to-day things. So I think it's an interesting question. I don't have the perfect answer. I think it could go either way. I certainly would expect some small increases middle or towards the end of next year. To what degree that goes up, that's really going to be the key as to how much stress would it cause from a credit standpoint. Any other questions come through while I've been talking, Swanima? Do you want to answer?
So the question on, do you have any data on leasing delinquencies by asset class and or fleet? So overall delinquencies have been low, whether it was auto lease or auto loans. So we have not seen any rise in delinquencies yet. So it's all low for all segments. Okay, and then there's a couple of questions related to buy now, pay later. Obviously, that's a huge market, or it's a market that's definitely on the growing side in Canada right now. Unfortunately, right now we don't get a lot of that reported to us. We're hoping that will change in the near future. So we don't have a lot of information around delinquencies and things like that compared to traditional cards. But again, we're hoping to have that soon for you. So we'll kind of hopefully in the new year we'll be able to give you a bit more information on buy now, pay later. So I did just want to take a few minutes. We do have a small business credit trend session that is happening on Thursday, which Jeff Brown will be leading. I know this is a consumer one, so some of you may be more interested on the consumer side, but there's a lot of elements of small business that heavily feed into employment and kind of some of the impact that can have both on the business side and also the consumer side, because it's heavily linked with income and things like that. So I do highly recommend joining that session if you have time. There is a great panel for that session on Thursday. If we didn't manage to get to your questions today, we absolutely will follow up and try and get in touch with you afterwards and share some of the thoughts. And as Jordan mentioned earlier, there will be a recording available of this should you want to go back and listen again. And there also is a downloadable version of the presentation as well.
Apart from that, I just want to say a huge thank you to Kathy for joining us for this session. I think it was incredibly helpful to see that potential piece around what can lenders actually do with some of these trends, and I hope you'll come back and join us next year as well. And thank you to all of you for listening to us for almost a full hour today. It's been a real pleasure. We hope you all keep safe, have a fantastic holiday period that's coming up, and we hope you will join us in the new year when we'll be talking about the Q4 trends. So thank you so much.